you have $100,000. Your only goal is to not lose it, all right? Not lose any of the purchasing power. Where do you put it?
Wow.
Same time horizon, 5 years, you still have $100,000. This time you can absolutely afford to lose it. It's the most exciting speculation.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
My next guest is Adrian Day, the founder of Adrian Day Asset Management, a top-performing gold fund manager decade after decade. Anybody with this kind of staying power in such a high-risk, volatile industry is always worth a listen. Enjoy. All right, Adrian, it's great to see you, and I'm really glad and happy to have you on the show. I know my audience has a ton to learn from you. You know, you've been in the game a long time, and you're definitely a personality that I have a tremendous amount of respect for. But for anybody who's watching that's not familiar with yourself or Adrian Day Asset Management, any of the things that you do, give us the quick brief. How do you focus your time, and what do you work on these days?
Okay, well, listen, first of all, thank you very much for having me on, Jay. You know, I manage money. I've been doing that since 1991 of my own firm. So we have both global accounts and dedicated gold and resource accounts. So a lot of what we do is in the global markets. I also manage a gold fund, Peter Schiff's gold fund. So I have a heavy emphasis on gold, but it's not all we do. And I mean, frankly, let's say 16 hours a day is spent on either managing money, which means placing trades, or researching, you know, etc. And then there's another half hour at the end where I have a newsletter.
Right. Yes. Yeah, I get your newsletter. It's fantastic. So, you know, you managed Peter Schiff's gold fund at Euro Pacific. I have to assume, Adrian, that activity and interest there has picked up dramatically in the last 6 months. Is that the case?
Yeah, since March, it's been a little slower in the last 2 months, since August, really, since gold has been going sideways. But yeah, tremendous interest in gold this year. Mm. And we haven't seen, you know, the ETFs have been seeing withdrawals in the last 6 weeks. We haven't been seeing that at all.
No. Right. Right. Now, you know, Adrian, you've built quite a career on finding contrarian bets, right? I read your newsletter. I've heard you speak at numerous conferences for years, including my own. When you look at the market today, what are some of the contrarian bets that stick out to you?
Okay, no, good question. Yes, I am fundamentally a contrarian, and you know, some of the greatest investors in history, like John Templeton, of course, have been great contrarians. You know, it's difficult being a contrarian right now, frankly, because even things that are out of favor are not particularly cheap. And when you're a contrarian, you're looking for things that everybody else is selling, nobody's interested in, which you would assume by their nature are inexpensive. But, you know, pretty much everything is to some degree or another overvalued. But there are some things we're looking at. I mean, you know, the first thing I would say, and this might sound a bit odd, is gold and the major gold stocks. I mean, I think if you're looking for a contrarian play, you look at gold, which is almost pretty much at all-time highs. You look at the outlook for gold, and we can talk about that separately if you want, but I don't think many people think that, you know, the gold bull market is over and, you know, this is all we get. So you got gold at all-time highs, a good outlook, and yet the senior mining companies, for the most part, are selling at, you know, 50% or 30% to 50% discounts from where they were in 2012-11, the last time gold was at these levels. You look at a company like Barrick as an example, second largest mining company in the world. It is, in my view, unquestionably a better company today. The new management, Mark Bristow, indisputably better than the last management, a much stronger balance sheet, from $12 billion of debt down to 4 billion, and a much stronger net debt position. Lower costs, better, the operations are more efficient, et cetera, and yet the stock is less than 50% of where it was in 2011. So to me, that's a contrarian play, even though typically most people aren't going to think of gold right now as a contrarian play. Mm-hmm. But I would say that number one. You know, we're looking at, as I say, most markets are overpriced, and they're either overpriced in absolute terms or they're overpriced relative to their own history. Because different markets, as you probably know, tend to trade in different kind of multiples. You know, the British market, the UK market, for example, typically has a higher yield than the US market. So you can't just say, oh, the UK is at 4, the S&P is at 1.5, therefore Britain is half as cheap. You've got to look at it history. German companies and Swiss companies, I mean, any kind of Germanic market, Austria, Switzerland, Germany, they tend to trade at lower price to book value multiples. So, you know, we could go through all of this, but where I am finding at least relative value, and I think a contrarian play would be in some of the larger Asian markets, particularly Singapore and Hong Kong. You know, Singapore's yielding almost 4%, trading under book value. They've got a recession, first recession in many, many years. And with the lack of global trade at the moment, Singapore does very well with global trade and oil because ships pass through Singapore Straits, the Malay Straits, next to Singapore. A lot of oil ships offload and reload. So Singapore is out of favor at the moment. As I say, they're in a recession, and the market is very, very cheap. And Singapore stocks typically are, you know, well managed. The accounting is good. The regulation is good. Hong Kong is another market that's out of favor, even though China itself is not so much. People are, and that's a bit of a little bit perverse. But people are comfortable investing in China, and yet they don't want to invest in Hong Kong because of what China's doing to Hong Kong. But Hong Kong is definitely out of favor at the moment. But again, 3% dividend yield, 10 times earnings multiple, just above book. So we're finding some very good things there. But I would have to caution in relation to my earlier comment about looking at the history. If you go back 30 years in Hong Kong, the typical dividend yield is 5 to 6% for the entire market, right? We're now at 3%. So does that mean it's twice as is overvalued by a multiple of 2? I don't think so, but just a caution. Mm-hmm. And I guess the other contrarian play we're looking at, and this is more of a short-term contrarian, is we're buying volatility. And the volatility indices went way up ahead of the US election, as you probably know and probably could imagine. But it's amazing to me that they've collapsed so quickly. So you look at the VXX, which is an ETN trading on New York, and that's gone from over $30 to about $18 right now. So volatility has just collapsed. What we're doing, and this is only for people who, you know, truly understand what they're doing, is we're selling puts on the VXX. And, you know, you can sell a December put, which is just a month away, and you can get 3% on your money on an under the market put. So the VXX is at about 1840 right now. We're selling December 16s, getting 68 cents, which is 3%. And if that was put to us, that would be the lowest price since February, before the pandemic started. Right. So obviously the fact that the election's over, election day is over. The fact that we've now got a vaccine, that's obviously hurt volatility. But I don't think that the problems and the concern about the economy and the stock market are over by any means. So you know, buying volatility is very cheap right now.
Okay, I'm with you there. And, you know, it actually ties back to your comments about gold price a little bit, and it is counterintuitive to imagine gold could be the contrarian bet when it's at all-time highs. But to your point about playing the miners at a 30 to 50% discount from 2011 highs, and that's where a lot of my audience is looking right now for opportunities, myself included. Now, Adrian, what do you think? Because you're obviously relatively at least bullish on the gold price, despite it being at all-time highs. I think, you and myself and anybody watching this can agree the macro forces supporting a gold bull narrative they're stronger than I've ever seen them in my career. And so how far down the food chain should investors be looking right now? If they're looking, so you've got your physical, you feel good about that. It's a buy, hold, forget about it strategy, but now you're looking for price appreciation. You can look at the miners, the developers. Are you looking at the explorers yet? You personally, where do you think investors should be focused?
Yeah, we're looking at the whole spectrum.
Okay.
But what I would say to people is, and this is obvious, and I know some people tune out when you say this kind of thing, but it really depends on the kind of person you are and your risk tolerance.
Yeah.
Particularly if you're new to the sector. I can't tell you, Jay, I had so many people come to me who are new to the sector. They want to be in gold because they've read this, and this, and they see our results. I'm not allowed to tell you what they are, but they see our results for the first half or something and say, wow, I want some of that. And they will, and I'll talk to them, but they're not listening.
Okay.
And then, you get August and September. Hey, why isn't my account up? I thought gold stocks were going up. Well, actually, blah, blah, blah. So I think it's critical that people really have, particularly if they're new, they really have an understanding of the market. Volatility is inherent in gold stocks. It's inherent. You cannot avoid it, even with the big cap stocks, even with the most conservative of the stocks. And secondly, have a true understanding of your own risk tolerance. And that's financial risk tolerance, your need for cash on an urgent basis. And so don't overdo what you put into gold. And secondly, and most equally important, your psychological tolerance for risk. Some people look at a stock that goes down 20% in 2 days and they shrug it off. It's gold, what do you expect? Other people can't sleep. Mm-hmm. So having said that, we're looking at everything, but honestly, Jay, someone well, Rick Rule likes to say, don't buy hamburger when the filet's on sale. And I think the filet is on sale right now. So not disparaging the exploration companies, but you just don't need to take that kind of extra risk. Mm. If gold goes from 2,000 or 1,900 to 2,500, as certainly as you can be certain about anything, that Barrick will go up, that Agnico will go up, that Goldfields will go up, etc. That Franco will go up. Maybe Ajax Exploration won't go up because they didn't find anything and they ran out of money. So at the moment, we are focusing on the big cap miners, but very, very selectively, because frankly, most of them are not good quality companies. And I don't like the GDX and the GDXJ because they include everything. I think you need to be selective in this market. So that's number one, the big cap miners, but selectively. Number two, we're still buying, for people who don't own, the big, good quality royalty companies like Franco and Wheaton. Yes, they're not cheap. Yes, they may not be the best performers in a strong gold market. But one thing I can be almost certain of, because I can't guarantee anything, but one thing I can almost guarantee is that they will not be your worst performers. But the risk is low relative to other things. So you get exposure to the market and you have low risk. Thirdly, we're looking at the junior producers, the single mine producers, the intermediates, companies that have the ability to either A, grow, and with the growth comes multiple expansion, or B, be taken over. And then we're also looking at the exploration companies. But in the exploration space, I personally, because I'm not a geologist, I personally prefer to look at companies that have a low risk business model, as opposed to companies whose property suggests that they could be a 10 to 1 or a 20 to 1. So
Right.
I'm looking at maybe prospect generators or royalty companies, something that has a low risk business model. And in all of those, I'll finish on this, in all of those areas, from the biggest to the smallest, the number one thing I look at is management. Management is absolutely key. And you only have to look at, let's just say Franco or Agnico, with very, very strong CEOs for 20 years, and look at how they performed against companies, no names mentioned, where management isn't quite as strong. But it's important for the large caps and for the small caps.
Yeah, it's interesting to hear you say that because, my core focus is pretty speculative, right? My portfolio's pretty spec at the moment. And, but right now I'm looking for junior producers. I'm looking for companies a little bit higher up the food chain, junior intermediate. My investment philosophy has always been people first investing. I mean, as you know, it's like the small cap, you're not betting on anything, but to your point, the judgment and decision-making competency of one or two individuals at the top of that pyramid. Are they going to surround themselves with other great people? Are they going to chase only the best business opportunities and not throw good money after bad? And are they going to be good stewards of your capital, right, at that early stage? But I haven't been as certain that's the best strategy as we move up the food chain into the producing companies. So it's reaffirming to hear you say that, Adrian, that's still your number one criteria is people, no matter where you're at.
Well, you only have to look at Barrick, which I mentioned earlier. And I don't want to pick on them, but look at the management that they had from 2009 to 2017 and look at what the stock price did.
Right.
And then when they merged with Randgold, they say they acquired it, but I think it was a merger. And Mark Bristow took over. Look at what the stock's done, but equally importantly, look at what the company's done. Slashed its debt, it's absolutely slashed Toronto head office. And I feel sorry for people who've lost their job, but that was just a bureaucratic waste of money. It wasn't actually, and he's pushed management down to regional offices, down to mine level, and made the mines much more efficient, etc. So you just look at everything he's done in less than 2 years. He's reacquired Arcadia. He's settled the dispute with the Tanzanian government. He's merged with Newmont and Barrick Nevada operations, which is something both companies have been talking about for decades. And yet he came in and was able to do that within, 9 months. So management makes a difference, there's no question.
Right. Yeah. Okay. Now I want to jump into some specific commodities with you. Do you call prices, Adrian? If I were to ask you to forecast a gold price, would you be so daring?
Well, sure, of course. I'll answer any question you give me. I'll give you a price, but not a time. Or you want both?
Well, forecast. Let's talk. I want to run through just a couple commodities. We'll start with gold outlook for 2021. Any expectation about where that price should move to?
Yeah, sure. But I think you have to say what it's based on. I mean, to me, the number one reason gold has been going up, the number one reason is what the central banks are doing. Around the world. We can talk about Chinese jewelry demand, or we can talk about, real interest rates, or the dollar, or whatever we want to talk about. But number one is what central banks are doing around the world. And the easy monetary policy, the excessively easy monetary policy, particularly in the US, Japan, and Europe, which frankly are the big three that truly matter, that's not going to change. It's going to ebb and flow a little bit, but we're not going to suddenly start raising rates and shrinking the Fed balance sheet. There's not even an intention of doing that. So, and we could talk about Biden and the virus and everything else, in a minute. But the question I ask my audience in the US is, do you think let's assume Biden wins the election, becomes president. Do you think that the new administration and the new Congress is going to start slashing or cutting spending? Nobody thinks so. Do you think that the Federal Reserve is suddenly going to say to Congress, you know what? You're on your own. You want to increase spending? Go out, raise taxes.
Right.
Don't think so. So the policy that has caused gold to go up is going to continue. Okay, sorry, I won't go on with that, but I had to get that in. So I think it's going to continue. We're just in a pause at the moment. Next year, by the end of next year, oh my gosh, we could easily see 2,500, easily.
Mm-hmm.
Because the other thing you've got to remember is, by and large, people, institutions, large and small, hedge funds, retail investors, mutual funds, generalist mutual funds, everyone is underweight gold. I mean, you and I might not be, but the vast majority of investors are underweight gold and gold stocks. I mean, when I first got into this business in the 1990s, that is the management business, you would look at different mutual funds. It could be Vanguard's big cap fund, or it could be Fidelity's small cap growth fund. Whatever fund you wanted to look at, they all had some gold exposure. It's not true anymore.
Mm-hmm.
And when gold starts to move up, people are going to say, maybe I should just have a little.
Right. Yeah.
And those littles all add up.
They do. It's a small market. Absolutely.
Yeah.
The needle. Now, are you looking at the silver industry? You're looking at silver producers, miners, physical right now, Adrian?
Yes, I am. I am definitely. And I mean, the thing about silver that we all know is, I mean, silver and gold really both react primarily to monetary. They're both monetary metals. And silver, despite it being an industrial metal, despite, over 50% of its use being industrial, and, despite the differences with gold, when you look at a 20-year or 15-year graph, the one thing it responds to more than anything else is monetary policy. So, and the thing about silver, as we know, is that it can have shorter, sharper spurts than gold. So I'm definitely looking at it. Yeah. There are fewer silver companies, and even some of the companies that everybody thinks of as silver have a majority of their revenue and assets in other metals. That's the dirty little secret. There are very, very few pure silver companies out there.
That's right. Yeah, there aren't very many. There's a few. Now, given that you've identified that the main driver of both the silver price and the gold price being monetary policy, how much emphasis do you put on the gold to silver ratio as a leading indicator?
Yeah, I really don't. I'm not a big fan of these ratios. And, there's been some fun, as you know, with the sort of Bangladesh monsoon season has the closest correlation to the S&P. And, it's a meaningless ratio. With gold and silver ratio, I think we have to understand that the market has changed fundamentally. The silver market has changed fundamentally in the last 20 to 30 years, both on the supply and demand side. On the demand side, of course, photography is the number one big difference, and that's not coming back. That's not a cyclical thing. So looking at a ratio when the majority of silver demand was photography is sort of meaningless. It's a different market. Secondly, the other thing that's critical to understand in the silver market is that 25 years ago, 75 to 80% of silver came from primary silver mines. Today, it's about 30%. Most silver today doesn't even come from gold mines as a byproduct. It comes from zinc mines, lead mines, tin mines. Well, your Malaysian tin producer, he does not respond. He doesn't increase production because the price of silver has gone up. He doesn't decrease production because the price of silver has gone down.
Right.
So silver production doesn't respond very well to the changes in the silver price. And that's critical. It's more critical than with gold, because silver, of course, has very few, other than scrap, it has very little above ground storage of silver. Government supplies, for example, are minuscule compared with gold. So there's not a lot, absent a huge run up in the price of gold. By huge, I mean well over $50. Silver.
Yeah.
You're not going to get a lot of supplies come onto market. People who didn't sell grandma's silver dining set in 1980 are probably not looking to sell it now at today's price. So, At the margin, I'm talking about, obviously.
Yeah.
So, but it's a different market. So that's a long-winded answer. I'm sorry, but no, I don't put a lot of.
Well, that's consensus as well with a lot of the personalities that I talk to. Not a lot of emphasis put by the smartest people I know in the industry on that ratio, which makes a lot of sense when you explain it like that. Now, I have two questions for you, two final questions, Adrian. I think they're kind of fun. But the first one is that, okay, so your time horizon is 5 years. Okay, you have $100,000. Your only goal is to not lose it, all right? Not lose any of the purchasing power of that $100,000. Where do you put it?
Wow, is this Canadian dollars?
Go with either or, US or Canadian.
You know, I think the answer, if you don't want to lose purchasing power, the answer has to be gold. And if you look at gold on a historical basis, I know you said a quick question. If you look at gold on a historical basis, it's really the only asset in a broad sense, because some stocks of course don't, but it's the only asset in a broad sense that you can rely on to preserve your purchasing power over a long period of time.
Yeah, okay, I love it. Second question, same time horizon, 5 years, you still have $100,000. This time you can absolutely afford to lose it. Where's the most exciting speculation?
If I were to invest it today, not sort of wait over the next 6 months and see what comes along, but invest today, it would be gold stocks, no question. And, you know, if I'm looking for maximizing my return, which I think was your question, then I am going to go down the food chain.
You are.
You know, because for juniors, don't get me wrong, I don't want anyone to be left with the wrong impression. I'm talking about hamburger and filet and so on. But the exploration companies, by and large, are remarkably undervalued today, remarkably undervalued. And of course, they have the potential to go up 5, 10, 20 to 1.
Yeah, I mean, that's where you get that exciting torque, as long as you can afford to lose the dough and still sleep at night. That's the ingredient there. Okay, look, it's been awesome catching up with you, Adrian, and just great having you on the show. I know my audience is going to appreciate this.